Okay, so let's get started. We want to look at company accounting. So company accounting. So for company accounting, it can be it can be given the topic capital structure and finance cost. It's still the same thing. So remember, we can start a business. You can run a business as a sole trader. So for a sole trader, it's one person that's running the business, one person that's controlling the activities of that business. That's a sole trader. Then besides being a sole trader, we can also run the business as a partnership. You can run the business as a partnership. So with a sole trader, we have a partnership. Then besides being a partnership, you can also run the business as a company. So you can run the business as a sole trader. You can run the business as a partnership. You can run the business as a company. So we want to focus on the company today. So if you want to start a business as a company, where can you get the money from? So the first thing to understand is the source of finance. Sources of finance for a company. The first thing to take note of is the source of finance for a company. So if you want to start the company, or maybe you've already started the company, if you need money in the company, where can you get the money from? So the money can be obtained from debt finance. You can get the money from debt finance. You can also get the money from equity finance. So the capital can be obtained from debt finance, or it can be obtained from equity finance. What is the difference? If it's debt finance, you have an obligation to repay. So debt finance has to be repaid at a later date. So if the finance is debt finance, it means there is an obligation to repay. You have received the money, yes, but you have to repay it back to the financier. Whoever gave you the money, you have to give them that money back. Or you can have equity finance. What is equity finance? So this does not give the entity an obligation to repay. It grants the holder a share in the company. A share in the company. So instead of us repaying you for that money you have given us, if it's equity, it gives you a share in the company. For equity finance, it gives you a share in the company. That is if the money is obtained externally. If it's someone who is giving us the money, it means we don't repay them back, but it gives them a share in the company. So if it's debt finance, which are the examples we can talk about under debt finance? So debt finance, we can talk about redeemable preference shares. So if we get money through the issue of redeemable preference shares, besides the redeemable preference shares, if we also get money through the issue of debentures and loans. Loans and debentures. So we can issue loans, or we can receive loans, or we can issue debentures. So they are all loans, but debenture, it can be a loan from an individual. You can give someone a debenture certificate. What happens is we give you a certificate, then you give us, you borrow us money, then we'll be paying you interest on that money until we repay the money. So it's just like a loan that we give you a certificate, then you give us money, then we are going to be paying you interest as long as you are having that certificate until we repay you back the money. So it's part of debt finance. It has to be repaid. Then we have equity finance. So for equity finance, which are the sources of equity finance that we can talk about? Those joining online, just confirm. Are we still together? Is my sound still clear and my screen show?
Confirmed.
Okay. So the equity finance, this is either the money we have generated ourselves. So equity is not only given from outside, it could be money that we have generated ourselves, like retained profit. So if we want to finance the business, we can use the money that we have made in the business. That's retained profit. But what about if you are starting to operate, or if the money you've generated is not enough? You can issue shares, ordinary shares. We can also issue irredeemable preference shares. We can issue irredeemable preferences. These are part of, these are all classified under equity finance. Then we can also look at other forms such as sale of idle assets. But the ones that I'm more interested, I think I've listed them. So let me start with the first one. I'll start with the loans and the debentures. So loans and debentures, these ones are loans and debentures. The business pays interest until the maturity date. So we pay interest until we repay at the maturity date. So at the date where if the assets have been, sorry, not the assets, if the loan has matured, let's say if it's a 5-year loan, after 5 years, we repay the loan. During the period, we'll be paying interest. So for this one, there isn't much of an issue here. So for this one, there isn't much of an issue for loans and debentures. Just need to know in the business, we are going to be accounting for the finance cost, and also at the end of the repayment period, we'll repay what we have received. Then, in terms of preference, the debenture holders, or those that have given us loans, they have the first preference. So we pay their interest first before paying any dividend. So before paying the shareholders, these ones, they are paid first. They are paid first before the shareholders. So they are paid first their interest before the shareholders. Then let's move on. Let me leave the redeemable preference shares a bit and skip to the retained profit. So retained profit being part of equity, what is retained profit? So retained profit, this is the money that we have made during the year and the other years that we have set aside. So in the company, if we make profit, we don't consume all of it. We set aside some of the money so that we can get to use it in the other years to come. So the retained profit, this is the money which has been set aside for all the previous years. So we want money, we can use our money that we have been setting aside. So this is the money set aside, the company from the previous years. So the money which has been set aside from the previous years, that's the retained profit. Then besides the retained profit, so this one we have no obligation to repay, number one, and number two, there is no interest that we are paying. So under good circumstances, we should use our own money because there isn't any debt attached to it. There isn't any interest attached to it. So we have the retained profit. Then besides the retained profit, we have also talked about the selling of idle assets. So this is where we have assets that we are not using in the business. We can simply dispose of those assets. Again, that can give us money in the business. So selling idle assets, we are selling those assets which are not being utilized. So now let's get to look at the issue of shares. So another way of financing the company is issuing shares. The issue of shares. So when shares are being issued, they are either issued as ordinary shares or preference shares. So if you are an ordinary shareholder, these grant the holder voting rights in the company. These grant the holder voting rights in the company. Why do they grant the holder voting rights? They grant the holder voting rights. What do I mean by that? It means if you buy ordinary shares, you are actually part of the management. You also vote because the shareholders of the company, by the way, they are not the ones that run the company. The company is left for directors to run it, but the shareholders annually they sit on the AGM where they will make decisions regarding the future of the company. The ordinary shareholders can vote at the AGM where all the shareholders meet. They can vote for the future of the company, deciding on how the company is going to be run, even on deciding who should be the director of the company. So these ones, they have voting rights. But since they have voting rights, they do not have fixed dividend. Their dividend is variable. They receive variable dividend. The term variable dividend, it means that if the company makes profit, they get dividend. But if the company is making losses, they may not get any dividend. Which is fair enough. Why? Because we are saying you are the ones who were voting for the decisions taking place in the company. So if the company makes a loss, you are the ones responsible. You caused that loss. You made the wrong decisions. If the company also makes a profit, we can also argue and say, no, it is because of our good idea that the company made a profit. So in the event that there's a profit, ordinary shareholders get to enjoy a large dividend. But if the company makes a loss, they can go the whole year without a dividend. Then another thing, it's always expensive to issue shares, or we can say dividends are expensive than interest. Some might argue why. Dividends are expensive than interest. Why? Because dividends are paid forever. They are paid in perpetuity. But interest, you only pay it for a certain period of time. So in the long run, it's expensive to issue shares. Why? Because you pay dividend forever. Unlike loans where you can repay at a later date. Then let's move on. So we have ordinary shares. These ones, they are part of the owners. They have variable dividend. Then we have the preference shares. The preference shares, these do not grant the holder, voting rights. Unless we can have, however, different types of preferences. We can have those that are classified as participative. You can come across participative preferences. They will be preferences, but they are granted the right to vote in the company. But generally, preferences do not carry voting rights. Then, because of them not participating, they will also argue, so please, if you are not allowing us to vote, give us a fixed dividend. If you make a profit, if you make a loss, that's your own fish to fry. So they get a fixed dividend. It is a disadvantage if the company becomes profitable because their dividend does not change. So if you're someone who does not want to take risk, you can opt for preference shares. You get a fixed dividend. You are assured, you are cushioned from the fact that the company can make a loss. You still get a dividend whether the company has made a loss or made a profit. Then now let's move on to the preference shares can either be redeemable or they can be irredeemable. The term redeemable preference shares implies that at a later date in the future, we can decide to buy these shares back. In fact, it's agreed that maybe after 4 years, you are giving us money and we are giving you shares now. But after 4 years, you give us back the shares and we pay you back your money. So these are shares that can be later bought back by the company. These are shares that can be later bought back by the company. So these are shares that can be later bought back by the company. So if they can be later bought back by the company, if these shares can be later bought back by the company, it means that they have the same nature as a loan. Because remember, a loan, we have to repay it back. For these shares, we'll repay the money back. So this is the main reason why they are classified under debt finance. It's because we have to repay them back. Remember, what did we say about debt? It has to be repaid at a later date. And these shares, someone is giving us money and we repay them back. Instead of giving them interest, we'll be giving them dividend. But the dividend is also fixed. So they are just more like a loan. So these ones, they are treated they are treated as non-current liabilities in the business. Non-current liabilities in the books of accounts. Not as equity, they are treated as non-current liability. Take note of that. So that's the redeemable preference shares. They have to be repaid at a later date. Then the opposite to that is the irredeemable preference shares. The irredeemable preference shares. The irredeemable preferences, these do not give an obligation to repay. These do not give the holder an obligation to repay. These do not give the holder an obligation to repay. These do not give the holder an obligation to repay. These do not give the holder an obligation to repay. So that's the irredeemable preferences. They are part of equity. They are part of equity because we have them forever. Part of equity of the business. So include them as part of equity of the business. They are included as part of equity. Now, we can also have participative preferences. Like I said, these ones are given the right to play part in the decision making. So they also are given that room to vote. We can also have cumulative preferences. So the cumulative preferences, they allow their dividend to accumulate. If we don't pay them their dividend this year, we can carry it forward because by nature we're supposed to pay them, whether we make a profit or a lot. But the cumulative can say, let's carry forward the dividend to next year. You can pay us the dividend next year. But if it's non-cumulative, it means they have to be paid this year. We can't carry forward and pay the dividend. So let's move on. But the ones I was more interested in, the redeemable and irredeemable preferences, because there's a difference. One is a non-current liability, the other one is part of equity. Then now let's move to issue of shares. Issue of shares. So let's look at how shares are issued. So let's start with the basics. When shares are issued, we have what you call the par value, which is the registered value of each share. So let's have an example. We can say KD Limited issued, KD Limited issued 50,000 ordinary shares. $50,000 ordinary shares of dollar at $2.40 each. This was followed by the issue of preference shares. This was followed by the issue of preference shares of, this was followed by the issue of preference shares can say 60,000, 8% preference shares, shares of dollar. If the question doesn't mention, the assumption is they are irredeemable. If they are redeemable, the question would mention. So preference shares of 80 cents at, we can say 80 cents at $1.50 each. So let's start with the issue of ordinary shares. Ordinary shares. So let's start with the issue of the ordinary shares. So the company issued 50,000 ordinary shares of dollar at $2.40. So the 50,000 shares that we issued, the 50,000 is the number of shares. Number of shares. So I want to break this down further so that you understand these terminologies later on. So 50,000 is the number of shares. Then we have what we call the par value or the nominal value of shares. So the shares have a par value or the nominal value of shares. This will be reflected in the books. It always moves with the shares. They'll say dollar ordinary shares, or they'll say ordinary shares of dollar. So that's dollar. Sometimes it's not dollar. It could be any value. Then we have the $2.40. It's called the market value. In the market, the shares are going for $2.40 each. That's the market value of the share. Then the market value is higher than the par value. The difference is called the share premium. So when the market value is higher than the par value, the difference, we say $2.40 minus dollar, the $1.40, that is the share premium. So we've broken down the key terms there. So we have the number of shares, the par value, the market value of each share, and the share premium. Then on the issue of the preference shares, the preference shares, they have something which is, they have one additional thing. The rest is the same, the number of shares. We issued 60,000 shares. That's the number of shares, 60,000 shares. Besides the number of shares, we have the par value of these shares. So the par or nominal value, the par or nominal value of these shares is given as 80 cents. Then we are also given the market value. The market value being $1.50 of each share. Then besides the market value, we also need to calculate the share premium. So the share premium is the difference between the market value and the par or nominal value. Then the additional thing is the rate of dividend. So for preference shares, they move with the rate of dividend. We actually know how much are we paying them as dividend. So they move with the rate of dividend. The 8% is the rate of dividend. So that is the additional thing. For preference shares, for ordinary shares, the dividend is based on the profits the company has made. So it's not stated on the shares. But for preference shares, they actually know how much dividend they're supposed to get. Now, let's look at the journal entries to record the issue of shares. Journal entries to record the issue of shares. How do we record the issue of shares? The journal entries are to record the issue of shares. So when shares are issued, let's have our debit and our credit there. So when the shares are issued, money gets into the bank account. So when we issue shares, the company receives money, which gets into the bank account. So we debit bank with the money that we have received, and we credit share capital. So the share capital, we have share capital and share premium. So let's look at this. Let's start with the ordinary shares. So we sold 50,000 shares. In the bank, we record the total amount of money we received. So we sold 50,000 shares. Each share was being sold for $2.40. That's the market price. So what did we get in terms of money? 50,000 times 240. So we got 50,000 times 240. Then part of the payment went to the share premium. Part of the payment went to the share capital as well. So 50,000 in the share capital, we transfer the par value, or what goes into the share capital is the par value. So you multiply with the par value dollar. So that would be 50,000 here. Then the same goes for share premium. Now you take the 50,000, and for the share premium, you multiply by the premium per share. What was the premium per share for the ordinary shares? It was $1.40. So you'd say there's 50,000 times $1.40.